Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I am so glad to have a repeat guest on the program today, backed by popular demand, the annuity architect himself, John Lenz. Johnny,
hello, Stan.
Welcome back.
Thank you.
It's good to have you. Now, when I was thinking about the topic, and we discussed it, and John and I were on calls and going over this because we want this to be good for the listener out there. And by the way, welcome to all of the podcast listeners on all the major podcast platforms, and also you people out there that are watching us on the Fun with Annuities YouTube channel. And you can see our facial expressions and how unbelievably chiseled good looks of John Lenz.
Oh, yeah.
Which is unbelievable. But the topic for today, I was thinking, John, was laddering your way to FIA success. But that sounded cheesy, But what we're going to talk about today is indexed annuities, and how John has come up with some very unique ways that I have implemented and give him full credit for, because he introduced me to this, which is laddering the index options internally. But before we go there, Mr. Lenz, let's talk about laddering in general as understood by most people, CD, bonds, etc. Can you give them the brief overview, and then we'll segue into how annuities work?
Sure. Yeah, I'd say when most people think of the word ladder, they think of something with sides and rungs on it that in ascending order,
right.
And you start at the bottom and work your way up.
Right.
And that concept is used in the financial world and has been for a long time by people who purchase bonds that have a really short maturity, maybe a year, and then they'll go longer to 2 or 3 or 4 and out to 10 or even longer, because historically the yield curve gave people better interest, more money if they went longer. But then you lose liquidity when you go long term, and you have more volatility. So a lot of people have implemented these ladders where they'll put $100,000 in a money market account and $100,000 in a 1 year or 2 year, 3. They'll work their way out to $1 million. And then every time a year clicks by, their 1 year bond is mature and fully liquid. So they've always got liquidity, and they take that liquidity and push it out to the 10th year, creating a new 10th year rung. So you've kind of got that escalator ladder going on, where you're always replacing the high rung with the liquid money, giving you better overall return and diversification. So I think that's what people think of, either using CDs or bonds as a ladder for fixed income.
Yeah, and I tell people all the time, with interest rates at these current levels at the time of this taping, we kind of all know where they are. Some call them low. I call them normal because they've been there for a while, and hopefully they'll go up. But no one knows when they're going to go up, and no one knows when they're going to either go up or down. And that's the reason you ladder. So you're not trying to be master of the universe and Gordon Gekko, and not trying to guess when things are going to move. And so you have money coming due all of the time, so that you hopefully can attach yourself to a higher yield, or as a bond coupon if it's bonds, yield if it's CDs. And obviously we do a ton of laddering with MYGAs, which is the annuity industry version of a CD, which is guaranteed interest rates. Right now, at the time of this taping, the shortest duration that you can go is 2 years, but a 2, 3, 4, and 5 year MYGA ladder is one of the more popular things that we do. And with the 5 year being kind of where the yield curve analysis of where does the buck stop? Where's the sweet spot? It's kind of the 5 year. Do you agree with that at the current MYGA rate level?
Yeah, I'd say that's right. And industry numbers bear that out, that 5 years seems to be the sweet spot. And I think it's a spot where an annuity owner feels like they haven't gone out too long,
Mm-hmm.
uh, where, short-term interest rates and money market funds are, as of today and whatever it is, early spring, late winter, interest rates are under 0.5%, the 10 years under 2. And annuity rates are between 2 and 3 in that 5-year space. And as you know, you can get 3 and change if you go to 7 and chase 10 years out. But what I like about the ladder concept is it takes the guesswork out of having a dream about which way interest rates are going to go. You said it earlier. We don't know which way rates are going to go.
Mm-hmm.
If you ask 100 people, most of them today would say interest rates have got to go up. But 100 people have been saying that for 10 years. And interest rates certainly could go up. Inflation is rearing its head, and I think most people expect them to go up. But if you do a ladder and commit when that bucket of money becomes liquid to push it out to the long end of your ladder, you've got a plan, and you're not saying, well, maybe I think I want to reinvest that one short. You just keep pushing it out to the end, and you've got this constantly recycling of fixed income investments or annuities to keep your ladder in good form.
Let's pivot a little bit to the indexed annuity space. Now, you and I are, I know we look vibrant and young, but we have been around a while, and we remember the days when index annuities were first introduced in 1995. We were talking about those initial products from Keyport Life. You'll love this, John. I called it the other day on a podcast, Keystone, which is a beer, but it was Keyport that actually came out with it. But
yeah,
I consider you a true expert on indexed annuities. And when I have questions about indexed annuities, I do go to John. I call him the annuity architect for fun, but he truly is. And when we sell indexed annuities, a lot of times it's for the delivery system they provide to the income rider. So the income rider is the goal, it's the guarantee,
right.
It's the future income, and the indexed annuity is nothing more than the delivery system. And under that goal, if you say, hey, Stan, I want lifetime income in the future, I want it to start in 7 or 10 or 9 or whatever years, then the indexed annuity story from the standpoint of accumulation is secondary, and the lifetime income quote is primary. So you go to my site, we have the only income rider quotation calculator in the business that shows you the carrier name and the guarantee, and you can run lump sum and or reverse engineer quotes. And that just launched at the time of this taping. It just launched. So I encourage you to go to my site at The Annuity Man and pull up the income rider calculator and have at it. It took a long time and a lot of money to get there, but we wanted the consumer to be able to do that. But when people say, you know what, Stan, I don't really need the income, but I want a little bit better return than CDs and or MYGAs. So Stan, the Annuity Man, let's explore indexed annuities. I'd like for you to kind of do a brief historical on indexed annuities and what you've seen from the time in 95 and up to this point, and then we'll start digging into the topic of laddering these index annuities.
Sure. Well, as I think we did talk about once, and thanks for mentioning how old I am and been at this a long time, but I was at the initial rollout meeting back on the East Coast in 1995 when I think the actuarial firm Genesis built this product for Keyport and Lincoln Benefit. And Keyport rolled out this index annuity, and I looked at it and I thought, this is fantastic. So I literally bought the first one sold out here in where I live now in Washington State, and kept it for 5 years. And the proposition of index annuities then and the proposition of index annuities now is the same. And that is, you're going to give your money to the insurance company. You're going to get a rate of return on the upside that's tied to an equity index, such as the S&P 500 or some proprietary index where the insurance company collaborated with an investment bank. That's the upside with some limitations on performance. And on the downside, you're going to get your money back with either zero return or some nominal return, call it maybe 1%. So you get some of the upside, none of the downside. So unlike a multi-year guarantee annuity that we were talking about earlier, where you might get 2.5% or 3% every year for 5 years, and that's it, no more, no less. In an indexed annuity, you're going to get, let's say, 0 or 1 at the worst case, and maybe 4 or 5 on the upside. And historically, over, I've tracked these now for, gosh, it's 22 plus those 5 in the 90s, 27 years. And I'd say that the average return on the index annuity has been 1 to 2% higher than the equivalent multi-year guarantee fixed rate. So people have benefited from taking that extra risk, right? The risk of not getting the minimum guarantee or the high guarantee. And part of that, the stock market's been pretty good since then overall.
Yeah, the proprietary indices that are being put out there, that's one of the, initially I was a little concerned about that. I am still concerned when people show back tested hypothetical return numbers if you owned it 10 years ago. That's a common practice in our industry, which I totally disagree with, and I think you share those same opinions. Because you gave a great correlation about, it's like watching, you said it's like watching, give your football correlation on that. That was good.
Oh, well, I said it was a little bit like you and I watch a football game together, and then we say, hey, if we run this defense where they line up like this, then we'll beat them. And the analogy is insurance companies and football teams, now that we're talking about, they don't do the same thing the same way every week. Exactly. So I think that many insurance companies and their collaborators in investment banks went back in time and said, if we'd have done this when interest rates did that and volatility was like this, we'd end up with this great return. And of course, the market doesn't repeat itself. And so the back testing came up with a really nice marketing brochure showing 6.5%. But in reality, those returns have been, again, between 1 and 2% higher average. And there's some that have done better, some that have done worse. But I've owned one of those. I told you I bought that first policy in 1995. It had a 12% average rate of return for the next 5 years. And of course, that was an anomaly. The market was really good then. But now, today, interest rates have come down, and the S&P 500 index is still the primary index that insurance companies use when they create these formulas. And because what they're doing is buying options on the upside of the S&P 500, they've got to take some of that annuity money or some of the interest earned on the annuity deposit, and they call it the options budget, and then go out into the market and purchase some call options so that they can capture the first 3, 4, 5% of the upside of the S&P. If they're wrong and the market goes down, all they've done is lost that options money. They've still got your principal sitting there in a bucket because they've promised to return that to you after 5 or 7 years. So the proprietary index, which is, I know, the question that you asked, is in a collaboration with a big investment bank. And if you think about big investment banks or names like Morgan Stanley or JP Morgan or Goldman Sachs, and the list goes on. They've collaborated with big dozens of insurance companies and created these proprietary indexes where they've gone back in time and created an algorithm that gets hardwired into the annuity that says, based on this set of facts, we're going to invest assets in options, in growth, or international, or small cap, or large cap, or bonds. And then that interest rate gets credited to the insurance company's annuity. And that's the back testing, right? Because those things didn't really exist. You can go back in time and say, hey, the S&P 500 has done X for the last 10 years, 15 years, 20 years, 50 years. But these proprietary indexes, some of them are only a few years old, but their constituent parts are much older. And so that's what the back testing is all about, right? They can say, well, yeah, this index didn't exist, but the S&P 500 and bonds and international equities, those indexes existed. And our proprietary index is a sum of those parts.
So let's talk about laddering. And there's many types to ladder index annuities. You could ladder the surrender charges. In other words, you could say, okay, I want a 5-year surrender charge index annuity, a 7-year surrender charge index annuity, and a 10-year surrender charge index annuity. You could do that. You could ladder and this is what we're going to dig into a little bit more, but you can ladder the index option length. And index options can be 1 year or 2 year or 3 years. So you could ladder those with 3 different companies. You could do a combination, be fancy, and ladder not only surrender charges, but the index options internally. And then there's finally one way that you recently have shown me, which I really, really like. It's with one of the it's the highest rated firm that offers index annuities. Won't mention names because that's not what we do, but they allow you to ladder. They have 1 year, 2 year, and 3 year options, of which you can take one indexed annuity with a really strong company and do an internal ladder of those index options. But before we go into that, and I wanted to get to that because that's why they're listening to us. But let's go backwards just a little bit and talk about why there are 1 year, 2 year, and 3 year options, and historically how those have performed since you have been watching for so long, Mr. Lenz.
Sure. Well, the longer that you measure the equity markets, the more likelihood, the higher probability that you're going to have a predictably higher rate of return. Mm-hmm. So if you look at a 1 year in the stock market, it could be up 30 or down 30. If you look at it over a 2 year period or a 3 year period, all of a sudden that range starts getting smaller and smaller, and the chance of you losing in that longer period of time goes down, down, down until it's non-existent. I mean, there is no 50-year period in the history of the stock market where a person lost money in the S&P 500. Mm-hmm. There may not be any 25-year periods. There are very few 10-year periods and a few 5-year periods and all kinds of 1 and 2 year periods. So when an insurance company can go out into the market and purchase options on a 1 year, they're more expensive than a 2 year or a 3 year. So and the same thing is true in these proprietary indexes created by the collaborative, the banks, the investment banks. So if you'll allow them to work their magic for 3 years instead of 2, or 2 years instead of 1, they can offer a higher rate of return on the 2 and the 3 year. Now, that said, you might have a 1 year that's got a really good return only to give it back in the years 2 and 3. So what you and I have been talking about is to take this under one umbrella with one insurance company that has collaborated with 2 very well-known investment banks that have both built 1, 2, and 3 year proprietary options, and an S&P option for 1 year, and a fixed bucket where you get a fixed rate of return. So now you can allocate your money under one umbrella in 1, 2, 3, and then every time that 1 year comes due, you move it out to the 3. So you've always got 1, 2, 3, 1, 2, 3, and every time the option comes to the end of its period, it locks in those gains, assuming there are gains. Those gains can never be taken back. Unlike if you buy a mutual fund and it's up 10% this year and down 10% next year, you just gave back everything you earned in year 1. Mm-hmm. In an index annuity, if you get let's say a 5% gain in year 1, and in year 2 it goes down 5, you still got the entire 5 from year 1. And that's really one of the strongest reasons to own an index annuity as a fixed component in a portfolio like this. You just don't ever give up your gains.
The majority of index annuities sold out there, I would assume, are sold with the 1 year call option. Am I right about that?
Yeah, absolutely. First of all, most of the indices that were created were on a 1 year basis, but there's plenty of 1s, 2s, and 3s. I think consumers in general understand that at the end of each year, if they have a 1 year option, that they've captured that interest and it's now locked into their account. And the insurance industry has realized that a lot of consumers just want to understand this, and at the end of the year they've made some money and it's locked in. If you have a 2 year index and it's up 5%, you've still got to wait another year to capture that plus the next gain. And sometimes that can be a little bit confusing, but overall you're going to get a better value by taking some of the 2 year, and even more value if you take the 3 year option.
You know, as you know, John, and most people that know me, that I'm a little bit of a contrarian. So about my life in general, And I'm certainly a contrarian when it comes to indexed annuities. And, you know, we sell a bunch. I don't hate them. I just hate how they're promoted and sold. Um, One of the things that people need to realize with, say, these S&P index options, these do not include dividends. And historically, with the S&P return, if you just look at it, and depending on where you're marking it and who's talking, some people say 54%, some people say 50% of the returns are dividends, but let's just say a lot of the historical return on a typical S&P 500 mutual fund ETF is dividend based. Is that correct?
Yeah, and that's again depending on how you actually calculate the number. If you took if you said, oh, the S&P 500 over a 30-year period has averaged 10%. Generally, that would be thought of as including the dividend. That would be the total return of the S&P. And in that period of time, the typical dividend yield on that, out of that 10, might have been 1.5 or 2% of the 10 is represented by the dividend. So if you just took a look at the index, that 10 really might be an 8. But if you took $100,000 30 years ago and compounded at 8, and took another 100 and compounded at 10, the 10 is twice as much as the 8. Therefore, you go to this 50% return. So it's a little challenging, but
Valid.
yeah, it's a lot less of the S&P 500's total return comes from dividend.
But with indexed annuities, we're not talking dividends attached. You know,
That's right.
with index annuities, and people can go to my site, and I've written a book, which, by the way, John was nice enough to edit once I wrote it, which was on the indexed annuity owner's manual. And we talk about spreads and caps and our participation rates, which are the limitations on the upside. But you have, you know, with this one company that does the 1, 2, and 3 year internally, and they're very, very strong. You like the ones that have, you know, a participation rate of over 100%. Can you explain that? Because I thought that 100% was just 100%.
Yeah, right. I think as of this taping, maybe the 3-year from one of the investment banks is
Sure.
actually at 100%, but it has been historically 110 or 120.
Okay.
So and I'm not sure I can explain that fully without an actuary backing me up. But these indexes are created by the bank, and depending on where interest rates are in the market and how volatile the market is, measured by one measurement is the VIX volatility index.
Mm-hmm.
Let's say this option was priced at 1 and you had some money to buy it. Well, you can actually buy 110% of that 1. And so, yes, there are times where we've had people get a higher return than 100% of the index. Most of the time, that's not the case.
Mm-hmm.
And today, a typical S&P 500 index is going to be 25 to 35% of the S&P index is what you'd be able to get in a fixed annuity. I mean, remember, 2 things I think are important to remember. First of all, an insurance company has a limited amount of money in your annuity to go out and buy these options. They call it the options budget, and it depends on how much actual interest they can earn on that money. So they take some of that interest and they go out into the market and they purchase these options, right?
Mm-hmm.
They don't purchase 100% of the upside of the market, give it to you, and agree to absorb all the losses.
Mm-hmm.
I mean, they cannot invest your client's index annuity money in the stock market because there's too much risk. They have to guarantee all your money back plus maybe a nominal interest, right, at the end of 5, 7, 10 years. So the companies have come out and said, we're going to limit your upside to what we can purchase, which is, let's say today, 4 or 5%. Or if you'd rather have 25 or 30 or 35% of the upside, then we'll give you that option as well. Now, in a big year of 20%, you'd rather have 30% of that than 4%, say in a cap. The good news is companies understand they don't know which way the market's going to go next year. So you can say, I'll take half my money with a 5 cap and half of it at 35% participation. So you can diversify, and it's kind of a coin toss to us.
And what people need to understand is when the index option, comes due, in other words, you buy 1 year or 2 year after those time periods, you can then change your choice. You're not locked into
Yep.
the choice. You can, and most of these products have multiple choices that we help you decipher, because otherwise you're just throwing a dart at it. And like I said, if you're talking about accumulation with index annuities, not an income rider. Once again, if you say, Stan, I need income in the future, then the index annuity is nothing more to us than the delivery system for that, the highest income rider guarantee. But once you say, hey, Stan, we're talking accumulation here, and I'm mature enough to understand it's not market upside with no downside, which is the pitch at the bad chicken dinner, expensive steak dinner seminar, and you're a grown up, then we can now talk about these index options and how we ladder them. And most people don't even look at it like that. Most agents aren't, I don't think, have the training or background to go into it and dig into it to that. I give the credit to John, because he was, I made a recent trip to Portland, and we were sitting at a very expensive steakhouse, of which I like to go to. And he was talking about this strategy, and it just really piqued my interest, because I've been looking for, it's not a killer application, but I've been looking for something that made sense to me mathematically.
Sure.
Because annuities are math, and John is a math geek like I am. And this is what he was talking about. One of the things that I laughed and almost spit out the Perrier at the table was he used a word called hybridize, Hybridize. By the way, that's not a word. It's a word that John made up. And anytime anyone uses hybrid when it's index annuities, I go crazy, because I always say hybrid's a car, hybrid's a plant, hybrid can even be a mattress. But when people use it to sell indexed annuities, they're selling it under the auspices that it's too good to be true, because it's hybrid and it can change colors, it can change and morph. What do you mean by hybridize, John?
Was that Perrier that you almost spit up? I think it was.
That was Perrier. I do not drink the funny water, John.
I think of hybrid as sort of a generic term to describe the cross melding of features. And so if I use the word hybridize or hybridized with you, I would have been trying to say we're bringing in the features, the best features of a fixed annuity, which is what? A predictable return with a guaranteed return of principal, some nominal interest rate. And then the features of the variable annuity piece of the market, which gives upside growth. And they've brought those things together into the index annuity. I could strike the word hybridize from my vocabulary going forward, possibly.
No, I really like that. I'm just glad you didn't use hybridize and the phrase cross-pollination at the same time. I would have had to just go, okay, I'm out. I have no idea what he's talking about, because now you're sounding too smart. But I understand what you're saying. And I think that when you strip down index annuities, which we do, done bunches of videos on them. And the reason I'm having you on is you are the annuity whisperer, for goodness sakes. You can really, really break this stuff down to where people can grasp onto it. I do think that there are good features that are attached that do combine other annuity types. The other thing that I want people to understand is, let's just say you said, okay, Stan, the annuity man, America's annuity agent, I do not need lifetime income. We want accumulation from this indexed annuity strategy, whether you're going to ladder multiple carriers or ladder index options with multiple carriers, or ladder index options with ladder surrender charge, or ladder index options with one carrier. And we'll discuss it all. Go to my site, schedule a call with me. We'll have this kind of a conversation about it. But what I wanted to get to, John, is I've come up with a phrase called defer to SPIA. I have it tattooed on the back of my leg. No, I really don't, but I should. And what I'm trying to say in a very long way is, you can take this indexed annuity strategy that doesn't have an income rider, but at the time you might need income or things change down the road, we can always either get the immediate annuity quote from the carrier, or quote all immediate annuities and transfer the indexed annuity to the highest paying immediate annuity. What's your take on the defer to SPIA as compared to attaching that income rider strategy, John Lenz?
I love that question. That's a question that I've thought long and hard about as we do analysis for people who come to us and say, hey, I want income, I think in 5 years. I'm 65, I want to retire at 70. My wife's the same age. What can you do for us in terms of guarantees?
Mm-hmm.
And so we think about immediate annuities, or the DIA, right, that you've talked about before, where you put it in now and turn the income on later. But I love comparing the indexed annuity with a rider, or a fixed annuity with a rider, which you put your money in, your income rider account grows, and then you decide in the 5th year if you want to turn it on or wait another year, right? Alternatively, you buy a fixed multi-year guarantee annuity and end up with 3% for 5 years, or you buy one of these 5-year fixed index annuities and maybe you get 3, 4, or 5%. Oh, 1, 2, 3, 4, or 5%. And now you say, I want to turn this into income. So instead of having paid a rider premium each year to get this rider, you now would have this larger bucket of money that you could go out into the market, and you have on your site. You can go out there and quote the entire marketplace of immediate annuities for now a person age 70, and then transfer the funds to whoever will pay the most. I love that idea. I think from a flexibility standpoint, that's wonderful. The downside is that if mortality trends, and I mean historical mortality trends are that we're living a little bit longer. If 5 years from now mortality trends continued and our life expectancy is longer, that's a little hurtful to payout rates for insurance companies, because on average they've got to pay longer. The last 2 years have seen mortality decreases due to a pandemic worldwide. Hopefully that's not going to last much longer. Now, I will say that 5 years from now, if you had to point a gun in my head and said, John, tell me whether you believe interest rates are going to be lower, the same, or higher, I'd say, okay, if I have to guess, I'll guess higher. That's going to inform higher payout rates for people who annuitize in 5 years. So I like this strategy. I would just say that you give up some guarantee because you're not sure what the payout factor is going to be 5 years from now.
Agree with that. And what I want all of my clients to do is be analytical with me, because there's no perfect answers, just bad sales pitches, of which we don't do. Right. There's no pound the table perfect way to do it. For people that want income riders, it's great, because for a future planner box checker is what I call them, John, to the penny what that income stream is going to be in the future, regardless of how long that future is, 7 years, 9 years, 10 years. And a lot of people want that. Also, if you want to lock in those mortality credits current, then you're going to do that with an income rider. Now, you are going to pay an annual fee that comes out of that accumulation value, not the income rider value, which I always kind of joke, John, hey, annuity companies have the big buildings for a reason, right? Right. And the other thing is, when you attach an income rider to an index annuity, I tell people this all the time when they say, Stan, forget the index annuity, I just want the rider, I want the guarantee. Great. But when and I explain it like this, if you draw a line down a blank sheet of paper, left-hand side is the index option side of the index annuity, right-hand side is the income rider side. Just about 99.999% of the time, the income rider side will be higher. Why is that, Stan, the annuity man? Well, the annuity company wants you to keep your money, and the only way to access that income rider benefit is to turn on an income stream. You can't cash it in or anything like that. And a lot of the upfront bonus, which I call candy for the stupid, a lot of the upfront bonus stuff, which is just another part of the contractual guarantee, is applied to the income rider. So we're not putting down income riders. What I want people to realize is, if you come to me and say, hey, let's talk about accumulation, Stan, you're not totally voiding the income thought. You're not getting rid of the income guarantee. What you're doing is saying, I'm not sure I need it now, but if I do in the future, then let's go shop immediate annuities at that time that we need income, or at the end of the surrender charge time period. And I think that is a gem of a strategy that just people need to put in the back of their head. It's in all my books, defer to SPIA, defer to SPIA, defer to SPIA. But this when we're talking about laddering index options, we have to throw in that at the end of that time period, we can always go shop SPIAs and do a 1035 transfer from the indexed annuity to the immediate annuity. That's a non-taxable event. Or if it's IRA money or Roth IRA money, traditional IRA money, it's a obviously non-taxable event going to the SPIA. So if you're czar for the day, John, how do you promote that better?
I'd say you did a pretty nice explanation of it there, and I would add one thing to it, because I know that's why you have me around.
Absolutely.
It's the Penn and Teller show, and I'm a little more like Teller, but I'll tell you what I think is, well, you're a big tall guy, like Penn Jillette, but not everybody who buys an annuity at 65 and gets to 70 finds themselves expecting to live to 100. There's a group of people in that group that have their first heart attack or find their first lump, and now all of a sudden,
wait a minute, wait, stop. Did you say find your first lump?
Oh, in your throat, whatever, breast. I'm trying to be a sweet, subtle cancer analogy here, let's say that people oxidize between 65 and 70. And all of a sudden, lifetime income is not something that makes sense, because, as you know, in order to beat the insurance companies at their own game, you need to be recommending lifetime payouts through annuitization, especially for people who are going to live out there to their late 80s, 90s, and beyond. That's where you beat the insurance company. If you have a short life expectancy, the last thing you would do is give your money to an insurance company and tell them, we want payments for life and you get to keep the rest.
Right.
Through annuitization, right? So what I would say is that the defer and annuitize later strategy offers a level of flexibility that lets you decide, number one, when you want to turn the income on. You might say, I was going to wait till 70 to take my Social Security, but I'm going to take it at 68 and annuitize this annuity you sold me and start now. Or you get to 70 and somebody says, you know what, I want to wait another couple of years and get a new bump up in rider and a new bump up in factor and get more money. Or the third, they found that lump and they're saying, yeah, I'm not going to turn on a lifetime rider. I want to take withdrawals over what I think may be my life expectancy of the next 10 years and leave the rest to my wife or spouse or kids. So I like the flexibility aspect of your idea.
And for the fee conscious person out there, everyone's fee conscious, you should be. All commissions that are paid to an agent like myself are built in to the product. It's a net transaction to you. Yes, we do get paid. If you want to know, I'll tell you what it is. Have no problem with that. But if you're fee conscious and you still want a lifetime income stream, going back to the deferred SPIA, you buy the indexed annuity without the rider, there's no annual fees. And then you transfer to the immediate annuity, there's no annual fees. You can literally strip the fees out of the whole thing if you want to do it that way. And I think that just people, I would say the majority of index annuities sold, you might know this stat, are sold with income riders, even though people might not need them. And I'm not saying, and a lot of people say, well, I need future income. We run that analysis. Okay, does the income rider make sense? Do you want to know to the penny what it is and pay that annual fee for the life of the policy as long as you're breathing? Or do you want to just strip that out and then ladder these index options, and then at the time you need lifetime income stream, and you might not, then we transfer it to immediate annuity. The other thing too, if you buy the index annuity under the laddering strategy John has been talking about, at the end of the duration, if you want your money back, we can send the money back.
Right.
I mean, people have this thing, well, if I give the money to the annuity company, they're going to keep it. No. You're with the index annuity laddering strategy, whichever ladder you choose, laddering surrender charges, laddering index options, or laddering index options within one carrier. You can do multiple carriers, whatever, and that's the conversation we have. You're in control of that asset. And I think that's lost in the messaging of all of this. Where do you see indexed annuities going? John, are we going to have the crypto indexed annuity soon?
I kind of hope so, because I've got a little bit of crypto, and if it was well enough received by the insurance industry, maybe more people would own some, and my fear of missing out would be rewarded. But I think index annuities, they're looked at closely by regulators.
Yes.
So there's lots of disclosure. There's lots of innovation. What we're seeing now is in the registered sector, where now companies are willing to expand the range of expectation. Like, hey, instead of giving you a 5 cap and a full return, we'll give you a 10 cap if you'll eat the first 10% loss, right? And it's not that those haven't been around for a while, but it feels like the range of expectation is broadening. The other thing that I think is worth mentioning, Stan, is that this isn't an all or nothing strategy. You don't have to say, gosh, do I have to pick between an income rider or defer and maybe think about annuitizing later? You can ladder that concept too and put half your money in something with a rider that covers base level forever, and then make a decision on what to do with the other piece. So people, I think, sometimes think that, oh, I got to choose between the two. And since neither you or I, despite the fact that Nostradamus is in our family tree, we do not know which one of those strategies is going to work out the best, because we can't see 5 years into the future to know where interest rates will be at that time. So I personally have 3 annuities, one of them using the defer and annuitize maybe at someday in the future, and then I have a product with an income rider on it.
I think that's a great idea about splitting the baby, as they say. Having an income rider with half attached to an index annuity. That's a commodity quote, by the way. Once you go there, then we quote income riders. And then having the strategy for accumulation, and then maybe annuitizing it at the back end. What people also need to understand, when you choose the defer to SPIA and you get to the end and you say, you know what, Stan, the annuity man, we have decided we want income from this indexed annuity that doesn't have a rider. We're going to, by law, you have to do this. We're going to have an annuitization quote from the carrier it's currently with, that index annuity carrier, if they offer that. And then we're going to quote every single carrier out there that has an immediate annuity offering. And then guess what? You get to choose the higher of the two. And that is called annuity fiduciary. And I laugh about fiduciary all the time, because if you're in the financial business, you should be a fiduciary. Okay. I mean, by you being in the game, you should be there. I snorted halfway through that.
Well, you did say something, pardon me for interrupting, that I think it's meaningful, that sometimes the insurance company that does the very best job accumulating your money over time is not the same company that has the best payout over time. They may have really good accumulation concepts, options, and a good value proposition that way, but they might think you're going to live a very long time and therefore offer a bit of a lower payout. Whereas another company is like, nah, we think people are not, their life expectancies haven't improved over time. So yeah, you've got to look around, and of course then own an insurance policy that has a finite number of penalty years so that you can end that and look without any kind of fee issues.
Tell me, John, about the surrender charges. I know that you surprised me a little bit that you said that you had located a 3-year indexed annuity surrender charge, but typically the 3, 5, 7, 9, and 10, is that typically where they're at? But I would assume that the 3-year MIGA is going to be really competitive with that as well from a guarantee standpoint.
Again, this is a yield curve issue, and the yield curve, right? That's you start down here at the very bottom with a money market return, Fed funds rate under 1%, and you work your way up to 5, 10, 20 beyond. And historically, the longer you were willing to invest, the higher rate you could get. Therefore, it had a traditional yield curve. It's not always that way. But when an insurance company is going to do a 3-year deal with you, they know they're likely to only keep your money for 3 years. And so the proposition, the option value return that you're likely to get is likely to be less than if you said, keep my money for 5 years, 7 years, 10 years. So and that's the same way as you said earlier with MIGA. A good MIGA today for 3 years might be 2%, and a good MIGA for 5 years might be 3%.
At the time of this taping. Absolutely. At the time of this people watching it 10 years from now, don't jump off the cliff. Just look at the date. look at the date of this. John, cover what's called renewal rates and why that's important for people when they're looking for this index annuity accumulation strategy. Why it's important for the renewal rate history of that issuing carrier to be fair to the consumer.
Boy, there's so many different thoughts I have about that, but I'll start with this, that, an insurance company, in order to get you to send your initial deposit to them, it's got to be competitive with their peer group. So as of the time of this taping, if you wanted to buy a 5-year multi-year guarantee annuity, 3% is a very, very competitive number. And with most companies, less than that. Now, the 5 years goes by, and let's just say interest rates stayed exactly the same in the economy. Most advisors, and I'd say most consumers, would hope that the insurance company would simply give them another term of renew the interest rate at 3%. But remember, the reason the insurance company was able to renew or offer that 3% for 5 years is that they put a penalty on your policy that they're going to charge you to leave early for the next 5 years. When the 5 years comes up, and if your money's fully liquid, they can't invest your money for a new 5-year term. They got to keep it liquid in what today would be a really low interest rate environment. So typically on policy renewal, insurance companies reduce interest rates for renewal. Now, it could be an economic issue, or it could be, which is also an economic issue, a profitability issue to the insurance company.
Right.
So as you do, and as we do, when the annuity reaches the end of its surrender charge period, we want the insurance company to have some level of integrity in their renewal. And if they don't offer that, then we have you use the word fiduciary, an obligation to the client to go out and say, hey, you're renewing at 1% here with this good company, and yep, your money's liquid, but you could get another 3% for 5 years, and let the consumer make a choice. And that same thing holds true with index options as well. Companies have to go out into the market and buy these options every year, 2 years, 3 years, whatever it is. Interest rates impact the price, and the volatility of the equity index impacts the price. So there are some moving parts in these products.
Is it fair to say that, and I look at you as truly the Svengali of this for me, and I'm glad that you're on this program, because people are getting your brain as well. For the listener and viewer, I don't think you understand the experience you're tapping into here. It's fantastic. There's so many indexed annuity offerings out there. Is it fair to say, John, that there's just a handful that, from an accumulation, offering and for lack of a better phrase, story, that you like?
There's definitely annuities that I would purchase myself, sell to my loved ones, recommend to advisors that trust my advice. And I think that there are some that I prefer better than others, Stan. But
it's a good way to put it.
I would also caveat that the people who are at insurance companies today, setting renewal rate practices and the direction of the company and the ownership of the company, that could change 5 or 10 years from now, and often does. And so that's why I think you and I have both migrated to the midterm surrender penalty period instead of the longest terms. Gee, there used to be, these annuities had 15-year lock-up periods.
17 years, yeah.
So you get in, and the insurance company could turn the heat down on you, and you're stuck. So I like something that sort of holds the insurance company accountable to offer you a fair, competitive renewal proposition, or you can pick up your money and go elsewhere.
And if you ever ask, there's a couple people on the planet that I trust when I call in and we're talking indexed annuity type accumulation. John is certainly one of them, that then I base my decision on what I'm recommending. So, you're getting some insight on how the annuity man process works a little bit. One other question about carriers, John. We talk about there's a lot of movement. There's a lot of hedge fund, private equity people trying to get in front of this baby boom demographic tidal wave of 10,000 baby boomers hitting age 65 every day. But you said something the other day, there are some mutual companies out there that do offer these indexed annuities, right?
Yeah, there are. We've mentioned and kind of agreed not to name names on our show here, but there is a company that's in a mutual holding company that has a extremely high set of financial ratings and touts themselves as the highest rated company that offers index annuities. That's important because, again, you want to put your funds in a place that you can trust and has strength. And recently, another very large, one of the top 3 or 4 insurance companies in the United States purchased a company that specializes in index annuities. So you can have your cake and eat it too here. You can have strength and a good proposition for your annuity and sleep well at night.
And if that's important to you from the standpoint, if you're looking at index annuities and you've gone to the Bad Chicken Dinner seminar and they mentioned a name that you'd never heard of, that doesn't mean they're bad. There's a lot of carriers out there and they don't spend money on advertising. But if you want to go with those type of mutual companies, they are out there. Just shoot me an email or schedule a call. We'll send you the information on it. We'll dig in and we'll show it to you. You're not you don't have to go low rent and find an annuity company that sells index annuities. You can go with the top ones. There are some out there. And, that's kind of why we're talking. John, I know you're not going to believe this, but we've gone a long time, which is good. And we're talking about index annuity laddering strategies of all things. So, I always ask you this and you never answer, but I'm going to ask it again, John. One last nugget of wisdom for these listeners out there?
A nugget of wisdom?
Yeah.
Oh, I will tell you this, that, and I don't want you to think that I'm promoting you here, Stan, but if you take Stan's advice and then take that advice and run out onto the internet and dig around, you're going to find it's pretty solid stuff. And at the end of the day, I am a consummate insider of annuities, and I own several of them. I want a couple of things: the return of my money, a fair return on my money, sleep well at night. This is the fixed part of my portfolio. I watch the stock market today. I watch some stocks go up, some stocks go down, the price of gold, the price of crypto. I don't look at my annuities every day because I know they increase in value every day, and I like that. So what I'd say is the nugget of wisdom would be that if you have some of your assets invested in this asset class, that it will give you the peace of mind to be able to go out and risk some of your assets into things such as equities that have higher rates of return historically, because you've got a base. And in fact, Stan, one of the things I meant to mention earlier was a big ladder. We talked about a 3-rung ladder, right? A 1, 2, and a 3, maybe a 4, 5. I did a ladder the other day for a case. It was a 7-figure amount of money, close to $2 million. And we've got money in a money market, money in a 1-year CD, money in a 2-year MYGA, 3, 4, 5, 6, 7, 8. And the final bucket is his equity portfolio. So it's everything from the safest thing on the planet, a short-term U.S. government money market, all the way out to the most aggressive thing on the planet, which is equities. But in the middle of it is packed with guarantees that have known returns. And it's a sophisticated $20 million net worth person that sees the value of this part of a plan.
I mean, that's excellent. I mean, I love hearing that because they do have their place. Annuities are not for everybody, but what we're talking about here today is principal protection and laddering the index options, however you choose to do that. I would encourage people to schedule a call with me, shoot me an email. If you want me to send you some information, I can send it to you, via email, or if you want hard copy, we can do that as well. I'll overnight it to you because that's what I do. But I think that's about it for us, Johnny Lenz. I appreciate you being with us. And I do appreciate all the listeners and viewers of Fun with Annuities. I'm telling you right now, it's one of the fastest growing podcasts out there. Never planned this, but when I bring on smart people like John, this is kind of what happens. So thanks for joining me once again, and we will see you next week on Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.